Hey everybody, it's Jim Hiles and it's Taxable Tuesdays. Well, taxes are up in the air right now in DC, so I'm going to try to say something intelligent about some of the basic things we should be doing. So let's talk about how taxes integrate within some investment strategies that you've got. So again, tax efficiency is the game here. It's going to be more important going forward because we're going to have higher income tax rates probably across the board. So we want to look at tax efficient retirement accounts. It's not always an easy decision because at certain ages it makes sense to not tax defer. If you're under the age of 50, you really have to look long and hard at taking advantage of whatever you can do to fund a Roth 401k, a Roth IRA, or for those of you that got the capacity to do that within your retirement plan, ask about a mega Roth 401k feature. It's just a feature within most 401k plans that is an add-on. Some 401k plans don't have these within their plan documents or their plan awareness. So it's an opportunity to do a non-tax deductible contribution to fund a Roth. Again, the good side on the Roth is don't get tax deductibility, but you've got tax-free growth. And if you keep it in there for at least 5 years, then you can take it out without taxes in the future and avoid things like required minimum distributions. So aside from that, over 50, you really have to look long and hard at saving taxes now. Traditional IRAs, absolutely should be looking at. Even if you can't get a tax deduction to an IRA, you get tax deferred growth on the growth in the IRA. You want to keep track of what you've made in terms of contribution, but certainly that's a great way to reduce taxable income on your investments. I have to look carefully at IRAs and 401ks as well when you talk about tax deferred growth because they're all subject to certain income limits. Diversify your account types. So basically what you're doing here is you want to have the maximum in a Roth, the maximum you can do in traditional IRAs or 401ks. Look at your individual brokerage accounts in terms of making them more long-term in nature. Long-term capital gains are still going to be lower taxable accounts or situations than ordinary income. At least we think so far. Wait to see what happens in the next month or two. Tax efficient investments, municipal bonds are tax-free in terms of their income. Unfortunately, it's just not very exciting to own one right now. So if you're interested in getting a 2% rate of return on a muni bond, maybe 3% on a long-term bond, you're going to take some interest rate risk as well. So you have to kind of look at the tax efficiency versus potential rate of return you're going to get on this. There are things called tax managed funds, and they do their best to offset gains and losses within the investment pools that they're managing. When you look at other things like how to use taxable accounts, so you want to have a bond allocation, for example, just to have some conservative in your portfolio. Well, you might want to own that bond in a tax-deferred account like an IRA because it's going to be generating ordinary income. So rather than owning your bonds that are taxable in personal accounts, consider kind of using tax location as an opportunity to potentially shelter the income that's spinning off from those income investments. I try to hold for the 12 months. I mean, ideally, we're investing long-term anyway. We shouldn't be, for most people, not trading accounts. We are in what we call generally the beta trade or the market trade, longer term, meaning that you want to buy and hold for the most part and let the market cycles go for 3-5 years plus. So that helps you hold beyond the 12-month time limit to go short-term gains versus long-term gains. Short-term gains are a lot rougher from a tax standpoint because of ordinary income tax. Harvesting, we do a lot of harvesting here already. For those of you who are doing it on your own, go ahead and take those losses. Hit the button, take the loss. It's on paper. Just turn around and buy something that you like or think you should own right now. And hopefully what you're buying gives you an opportunity to get out of what you really didn't like anyway, and you might have become emotionally involved with. So that's what I recommend doing for tax tips so far. Here you go, Jim Hiles signing off for now. Thanks.